Hello, everyone. Welcome to the Finance Magnates London Summit, the first session. Before we begin, I want to encourage you to use Slido. For those of you who don't know, Slido is a software for managing presentations and conferences such as this one. You have various options there. For instance, you can ask our distinguished panelists questions. You can answer and you can participate in our poll, which we will present at the end of the session. And you have many other options there. So for those of you who still didn't download the app, or you can use the web version, so please do. So blockchain is at the forefront of innovation today, enabling to transform the machinery of the existing financial system, as well as to offer new mind-boggling possibilities. Now is the time to ask whether we're looking at a niche technology that's optimizing the existing system, or one that will eventually replace it. So I would like to ask Sarah to take the stage.
Thank you very much. Good morning. Apologies for the late start. That is, I travelled in from outside London, would you believe it? So I'm Sarah Feenan. I work at Climatics. I'm product strategist there, and I know all of these chaps, and we've pulled together to bring this panel to really look at where we are now with blockchain technology and from an asset management perspective, and where we think it's going to go. I'm hoping that this panel, knowing these gentlemen, will be pragmatic but also very forward-looking and with a disruptive edge as well. So to introduce my co-panelists from left to right, we have Chris Wills, who has 20 years experience in asset management, Simon Taylor, who's co-founder of 11FS and of the Global Digital Finance Initiative, and Dr. Ian Hunt, who is an independent consultant and expert on the buy side. So to start with, we're going to look at the issuance of assets. So I'm going to start with Simon Taylor, who has been doing a great deal of work on global digital finance, pulling together a taxonomy and a code of conduct. So fire away, Simon.
Hello, Sarah. Is this mic on? Am I here? Hello, can you hear me? There we go. Hello, everybody. My name's Simon, and I've been in the blockchain space for about 4 years, maybe even a bit longer now, 2013. I was head of blockchain R&D at Barclays, where I would be wheeled out in front of the buy side a lot to show them the shiny DLT thing. And I found myself coming up against the rocks an awful lot of like, well, actually, we don't really need this, and actually, what's this really going to do? And over those years, I really sort of came to the realization that what we were talking about was less about this cost saving for middle and back office, and a lot more of fundamental rethinking of the entire asset lifecycle, which is kind of where we started. And yeah, I mean, these chaps can tell you a lot more. They wrote an entire paper and have a lot more experience from the buy side than I do. But it struck me then, as we saw the ICO bubble. Did anybody miss the ICO bubble of last year? No, you saw that? Cool. As we saw the ICO bubble of last year, what we were really seeing was technologists looking at this market space and going, like, the way you guys do this probably made sense when you made it up. But what we actually have is an entirely analog set of processes that we've digitized. And when you digitize a paper process, what you end up with is something very different to something that's born digital. So, like, the classic example of something that's digitized is, did anybody remember the early days of the iPad? When you could get the newspaper on the iPad, and the big innovation of the newspaper on the iPad was that you could turn the page of the newspaper on a screen. Wow. The only problem with that is I now had a newspaper that runs out of battery. Like, the only people that benefited from that was the newspaper company had reduced the cost of distribution. That does not work as disruptive innovation. Reducing the cost of distribution is not where you start. Where you start is a fundamental rethinking of the entire process. And so what you get instead is BuzzFeed. You get YouTube. This is something that is a step change in how people communicate. And that is what is coming to my mind to not only the buy side, but all of financial markets. So the stuff that looks really weird at the fringes right now in crypto land is slowly being thought through by very serious professionals, not only in the FX industry, not only in the entire buy side, but I think across financial markets. People have woken up and gone, huh, And what they're doing is they're starting to, as a friend of mine, Monty Mumford said, tiptoe through crypto. They're starting to tiptoe their way through and just have a little play with crypto on the edges, maybe with personal accounts, and starting to see that, wow, okay, if I were to lock up an asset, and if I were to kind of really immobilize it, as you said earlier, Ian, I like that term, then suddenly this asset starts to move at the speed of digital. And what possibilities does that create? Well, it creates immediate liquidity. Lovely, or maybe not. Because immediate liquidity is great for some people if you're looking to get rich quick and cash out of an ICO, but not so great for investors if there are no protections. So this ICO space has rightly, I think, now been clamped down on by the SEC and others. And what we're seeing is this sort of sensible side of crypto coalesce with the sort of, I guess, more credible side of the DLT world. And what I wanted to do was bring that together into something we've called global digital finance. So global digital finance created a code of conduct for the issuance and management of crypto assets. And when we use the term crypto assets, we use it in the same way that the FCA does. So the Financial Conduct Authority says that if you tokenize equity, if you tokenize a commodity, if you tokenize cash, that is a type of crypto asset. That's a mind-boggling thought, isn't it? That if you have a token that represents a real-world asset, you are effectively talking about this. So what are going to be the rules and standards around that? So these guys can talk a lot more to what the benefits of that would be, but hopefully that's some useful scene setting.
Yeah, thank you. I work with asset managers and asset owners, so I'm completely biased and totally buy-side oriented, but I'm going to give you a view which builds very much on what Simon has said. And if we look at digitizing or attempting to automate existing analog processes and congratulate ourselves for doing so, the benefits we're going to get from distributed ledger or any other technology really are going to be pretty limited. I think we have to take a much more fundamental view of the market structures that we're working with and work out what a digital from scratch view of the market and the market structures would be. And I think we start from that with just turning the whole kind of value chain and the institutions and the intermediaries that we have in the market, turning that on its head and thinking about who actually matters in the market. Why are we here? You know, we're not here to have stock exchanges. We're not here to have payment banks. We're not here to have clearing houses and central counterparties. To a large extent, I mean, you may represent them, but they don't really matter. They're not there delivering a primary good. They're there delivering very much a secondary facilitation role. And the people who really matter, the only people who really matter in the market and what the market is for, is two sets of people. There are asset owners who need, pension schemes, insurance schemes, funds that have a reason to exist and need to invest and need to have somewhere to gain return on their assets. And then at the other side, there are corporates who are capital issuers or entities that are capital issuers that need to raise finance. And the whole thing, everything else that we do, is just about bringing those two parties together in the most efficient way. And we as the buy side we as asset managers, we're very close to the asset owners. So we're the agents of the asset owners, and our interest is purely in making investment as efficient as it possibly can be. Now, at the moment, between the asset owner and the capital issuer, depending on how you count it, there are probably 15 intermediaries. So when we do a transaction and there's an exchange involved, there's brokers involved, there's then a central counterparty, there are clearing houses, there's netting going on. We then confirm with a confirmation service, with a trade processing service. We have settlement instruction databases, we have payment banks, we have custodians, we have depositories. We have a raft of intermediaries between ourselves as the asset owners and the capital issuers. And to go back again to something that Simon introduced, we have to think about why that's the case. And I would suggest to you that the reason why we have this blizzard of intermediaries is because our model of the transaction is completely outdated and completely inappropriate. So we have the idea of a transaction, which we accept and we believe is correct, and we just take as normal, where we have two parties to the transaction. They maintain their own records of the transaction, and then somewhere down the track, an exchange of value and goods, an exchange of value and asset happens, and that's called a settlement event.
I love that idea that everything you thought you knew is wrong.
Yeah, I think it is wrong. And it's wrong because that process worked when we were exchanging goods for gold, but automating that process is not a good starting point. And we congratulate ourselves that we've dematerialized, because we don't have runners running around the City of London with satchels full of share certificates. But what we haven't done is gain any of the benefit of that for the purpose of a digital exchange. So the reason we have the intermediaries is because if you separate the timing of settlement from the timing of transaction, then you introduce counterparty risk. So you have a primary need for a central counterparty. If you have payments and you have deliveries, like we had with physical stuff, with goods and gold, then you have a requirement for payment banks, you have a requirement for custodians to deliver stuff. Well, they're not delivering anything. These things are dematerialized. If you have settlement from one account into another, then you have a requirement for settlement instructions. If both of the parties take a record of the transaction separately, then you have a requirement for a confirmation service to make sure that their records are aligned. So all of these intermediations come from the fact that our view of the transaction is wrong. Our view of the transaction is an allegory of how transactions were before we even dematerialized. So if you take a view from a digital perspective and you say, well, let's make the transaction the same as the record of the transaction, and let's have one of them. So we have a digitized view of the transaction. All that we're exchanging is a token of ownership, a definitive title to ownership, and that is both the record of the transaction and is the transaction. If you take that view, then all of those intermediaries I've just mentioned don't need to be there. And they don't need to be there because there's nothing being delivered, there's no movement from one account to another, there's no payment, so there's no SWIFT messages, there's no movements from across the depository, there's no movement from custodian to custodian, there's no confirmation, there's no settlement instruction, there's no netting because there's nothing to net. So if we take that view, then we can eliminate the requirement for those intermediaries in their current roles.
That's quietly one of the most radical things I've heard today.
And why do we want to do this? I'll tell you exactly why we want to do this on the buy side, because investment is stunningly inefficient. It is absolutely unbelievably expensive. So if you look at the recent SEER committee from the FCA on the costs of investment, it points out that if you wrap in hidden costs, transaction costs, commissions that we charge the client, data costs, all of the hidden costs that are charged to investors, plus the asset manager's fees, plus all the other stuff that gets lumped in distributors, cost of funds that you're investing in that also charge. If you look at all of that, the cost of asset management, the cost of active management in the UK is about 3.5% of the asset value per year. If you have 3.5% loss taken out of your assets before they start generating any return, then over a 20-year pension investment period, you will lose more than 50% of the value of your fund. If you reduce that 3.5% to 1%, then you will lose maybe 20% of the value of your fund. And if you look at the deficits in the UK pension market, in the defined benefit pension market, they're at around 30% at the moment, running at around 30%. So the difference, that deficit, is not because investment returns are not very good. That deficit is because investment is stunningly inefficient. And if you reduce the cost of investment from 3.5% to 1%, you would address the deficit problem. That's why we're here.
I agree with everything they've just said. If I try and draw on both of these the points of view, the buy side exists, as Ian was talking about. It's almost investors to investments. And effectively what you're trying to do is to take an investor's money and within a regulatory mandate, within a governance, risk and control framework, within FCA rules, you're making that pot of money bigger. That's fundamentally what the buy side does. That's a very, very simple mandate that applies to everybody in this room. It applies to every institution. Everybody would love their money to get a little bit bigger every day. So the use case of the buy side is not going away. The use case is there.
But I think historically a lot of the revenue had come from those hidden fees.
Absolutely.
And actually flipping from that, well, I'll sit on my 30% margin, I'm quite comfortable with that, whether the funds perform or doesn't, versus actually I'm interested in asset net present value and growth.
So the point is that the disruption or the change or the thinking, the disruptive thinking, has to come from, ultimately, it'll be the retail end of the market. So the retail, so buy side we'll talk about retail, wholesale, institutional. All of that money comes from your individual pockets. It might be aggregated up into a pension fund. It might come through a particular fund platform, a Hargreaves Lansdown, et cetera, That money is aggregated from the individual, from the person. So what we really need to be looking at is the kind of solutions from that side of the market, rethinking exactly that investor to investment world, and blockchain and DLT and all of the nuances in between, as well as cloud and data analytics and RPA and AI and legacy, frankly, because if you can't interoperate with other blockchains, with other technologies, with the systems that exist right now, then you're not going to be a successful change of the model.
I think it's interesting you've defined the why really well. I mean, like losing 50% of the value of your pension, according to the Dr. Chris Sears study and the Leeds University study, is a massive number.
Well, imagine the social change that everybody's pension is double the size.
I'd quite like to double my pension. That would be pretty cool. Thank you very much. But actually, there's you mentioned another point that stuck out to me, and I think it links to what Sarah does in the day-to-day job. I mean, Sarah, at Clearmatics, you guys are doing something really deep on the institutional side, but it's not just blockchain you're using, right? There's cloud and there's lots of other technologies in there. It's not just DLT is not a panacea, and I think that's a common myth.
Yes, absolutely, and I think that's a more pragmatic viewpoint as well. So I think, perhaps culminating in the ICO bubble at the end of last year, we saw this kind of buzzword panacea fix-all. If you just call blockchain something in your company, you automatically get all of this
Well,
extra
Kodak did it, didn't they?
Yeah.
Kodak released a quote-unquote blockchain product and increased their share price. And I'm surprised that Elon Musk got hit before Kodak did, frankly.
Yes.
I mean, some of the stuff was frankly shocking. But actually, what you guys are doing, I mean, it might be worth explaining what you guys do in the FX market and kind of international
Yeah,
FX.
so I don't know, has anyone heard of Clearmatics out here? We're quite a small company. So we are the vision and the technology provider behind the project called Utility Settlement Coin. And that is a consortium of 17 global financial institutions, all working together to build a co-owned and co-used platform. I think the microphone's gone off. No? Oh, thank you. To use a co-owned and co-used platform to be able to create what is effectively a global real-time gross settlement service using blockchain. So the vision behind that is it's just like the panel has been saying here today, it's not just to increase efficiencies, it's really to be able to open up instant settlement of a cash leg of any trade. So obviously FX has two cash legs. You can also have some kind of asset as well, a different type of asset. And so maybe this might be a nice link into explaining a little bit behind your taxonomy and why we'd need a taxonomy from first principles.
Yeah, sure. So it struck me that there's a lot of language out there around DLT and there's a lot of hype, right? And actually, not every token is the same. Not every distributed ledger is the same. Some people say blockchain to mean one thing. Some people, and you end up with these experts arguing with each other all the time, and it all just appears very, very noisy, and you're just trying to get at what's the actual value here. So what we did is we created a taxonomy that's both visual and also takes a legal perspective, a business perspective, kind of a technology perspective, several different angles of attacking, like what are these token things and what are these different DLT things. And it fundamentally came down to a very simple split. You've either got a fungible token or a non-fungible token, and you've got got something that is either a real-world asset or that is a natively digital asset. Those are the two axes that at the simplest level. Fungible, really obvious. Kind of 1 Bitcoin equals 1 Bitcoin. Non-fungible, one piece of art is not quite the same as the other piece of art.
Are we fungible?
Oh, yes, indeed. You are, I don't know. You guys might be. You one Ian for a Chris. But actually, the natively digital versus real world assets that have been immobilized that's where things get really, really interesting. So if I immobilize an asset, if I say this car, this house is now immobilized in terms of where it sits at a global custodian and now trades at the speed of digital, on a distributed ledger between as many counterparties as need to, imagine the new transaction types and the new workflows that suddenly become available when moving the asset is the same as the payment, when the cash leg of the transaction is the updating of the records, and when instead of doing regulatory reporting and instead of having EMIR 39 and MiFID 2 to panic about, you just go to the regulator. Well, here's the ledger of all of our transactions. Here is, in fact, the mooted golden source. Just go look at it. So I think the benefit is really clear, but the language is really, really difficult. And you guys did a long white paper sort of translating a lot of this for the buy side.
I mean, Ian, do you want to tag team on this? Because one of my favourite case studies about this is on the private equity side. Is the Northern Trust in particular were looking at, private equity is an illiquid part of the market. It's a very esoteric part of the market with particular ways of doing business, which are non-digital. And actually, fast forwarding to the project that is effectively live in a portion of the market, you have the value chain is being prescribed, involving lawyers at the top who are looking to standardize what used to be completely, effectively OTC contracts in the private equity world, going all the way through the GPs, the LPs, so part of the buy side, and then down to auditors who are comfortable with that whole value chain, the transfer of ownership. Blockchain is a small part of that, but it's a key part of measuring, as Ian talked about, the measure of ownership and value across a range of counterparties. It seems to be a great case study of taking, the paper into digital, leveraging the right technologies.
Yeah, I mean, I think immobilization is the word of the day, and it's what tokenization allows us to do. And what we need to do is to tokenize and immobilize both sides of every transaction we can get our hands on. And that means that assets don't move, they don't get delivered, they don't get shunted around between custodians, and payments don't get shunted around between banks as far as we can possibly manage. And if you reduce the flows of those transactions, if you reduce the flows of asset and the flow of cash, then A, a load of cost gets taken out, and B, immediacy gets achieved. So risk reduces substantially. And if you think about, the perfect case study for this, and something which is becoming a popular use case in the distributed ledger world, is land registry. And a lot of national land registries are moving over to, or have projects to move them over to distributed ledger technology. And the reason for that is pretty blindingly obvious, which is that it's really hard to deliver a house. If you've got a house, you don't sort of move it to someone. When you settle a property transaction, the idea that you shunt your house from one person to the next, or from one person's custodian to the next, is absurd. The house is inherently immobilized. So when we sell a house, we don't give someone the house or move the house into a different account or whatever. What we do is move a token of ownership, which in legal terms, because it kind of tracks back to ancient history, is a set of title deeds. But the title deeds are just an immobilized and dematerialized view of the house. They're not the house, they're a token of the house. So in that context, it's kind of obvious that what you do is to move a token of ownership, and when that token of ownership moves, then that is the transaction. You don't expect the house to be put into a different custodian account. So what we're trying to do, and where we need to get to, is that we do that for other assets. And the absurdity in this is that we've dematerialized assets in the securities world, in the FX world, in the equities and bonds, well, these are dematerialized assets. They don't really exist. They're just book entries. But we actually still move them around, which is just stunning. And what we need to do is to immobilize them within the construct of a distributed ledger network, and they become the tokens, the tokenization both of cash and asset becomes the immobilized representation of both the asset and the ownership.
What I think is interesting is 2-3 years ago, you would have been having a very tech-heavy conversation. This is a very business-heavy conversation, and I think that's been the real step change from my perspective, in that you used to get blinded by the science, and now people are talking real business value. And you can imagine, like, all of that middle and back office processing that seems to be focused around, do my accounts reconcile? Where was that error? What's that break? What is my actual position, and does the regulator believe me? Suddenly, like, you make a point of, like, well, don't move the asset, kind of create a shared record which kind of shows you where the immobile asset token now sits. It changes the game completely.
It's that, you know, the whole of the buy side is predicated principally and built around a fund and a portfolio. And therefore you've had a whole set of regulations that have had to be put into place to protect client assets, you know, almost to backfill, you know, the kind of approach. And I think there's a methodology that says, well, why don't you start from the client assets themselves? And then they can participate in the immobilized assets on the other side. Start the funds at the other end.
Yeah, so something that's very obvious when you work in the asset management space is that there are loads of asset registers. Everyone has an asset register and an ownership register of some description. So we have the companies that the capital issuers have their registers, and they have their registrars who maintain a set of assets, a set of asset records, and a set of ownership tokens, a set of ownership mappings. Then we have the depository, apparently the ultimate proof of the existence of the asset. We have the custodian, who is holding the asset, apparently, for the clients who use that custodian. We then have multiple asset managers. They all have their asset registers and their ownership registers as well. The reason why we do this is because, again, we're moving stuff around, and we have the different representatives maintaining their view of ownership and their view of entitlement for different interested parties. If you move to a tokenized and immobilized world, then it becomes blindingly obvious that you only need one asset register. You need one proof of existence of the asset, which a blockchain is really good at doing in a immutable and secure form, and you need one set of records of definitive title to ownership, and that's all you need. And when you move asset, you just move the title of ownership in a tokenized form. So from our point of view on the buy side, doing this kind of thing, immobilizing asset and tokenizing, and then making the transaction the same as the record of the transaction, has a huge impact not just on transactions, but on our records of assets, positions, valuations, analytics, etc. And it massively simplifies that process of keeping our clients' inventory.
And if this sounds like a wonderful distant future, it's not. I mean, as you said, Northern Trust Alive, there's a company called Harbor in the US that are looking to do it. There's Templum, there's obviously what the guys at Clearmatics are doing. These projects are hitting production, and next year they're going to start hitting scale. And so suddenly it goes from, like, innovation has this awful habit of going, it'll never happen, it'll never happen, it'll never happen. Oh, of course it was always the case. There's never that moment in which, oh yeah, it's coming now. There's no time at which you get to catch your breath. It's like it's never there, and then suddenly it hockey sticks, and it was suddenly always the way it was going to be.
Yeah, it's definitely the case that this year is massively different from last year on the buy side, and in terms of commitment and participation to distributed ledger technology. And last year, 18 months ago, say, buy side 2 years behind the sell side, shuffling up to the starting line if you're lucky, spectating if you're lucky. Now we have a set of consortia wrapped around funds transfer, wrapped around transfer agency, with big names in them, names like Schroders, like M&G, like Aberdeen Standard, and they're putting money, resource and commitment and public commitment behind it. So that's happening. And then if you look at the enabling technologies, we have utility settlement coin, and that's not a plug because Sarah's here. This is a plug because it's an important, very important piece of acceptable market infrastructure, which is being taken seriously across the market. So it's not stained with Bitcoin. It's about responsibly transferring asset and transferring value in a tokenized form in a way that's acceptable to markets, regulators, and the central banks. And that's an important development.
So I think the call to action is get involved. It's absolutely, it's get involved with discussing with GDF, with standards, with collaborations, with consortia. You don't know what you don't know.
And if you want to find out more about GDF, you can go to gdf.io. But aside from that, I would really say that, yeah, no, it's a cheap plug. I felt the humour. But at the same time...
It was scorn.
Yeah, it was. I would say, though, there's no downside to being more informed. And there's no downside. Like, I've been on the forefront of this for 3 or 4 years. I'd say maybe 4 or 5 years even. I'm going more grey with each passing day. But there was a time in which I was genuinely trying to get people to pay attention to something that was coming in the future, and it was a little ways off, and I wanted to get them ahead of. Now it's a bit more like, I'll just open the door and you can go see for yourself. It's there. And I think that's an interesting change of the tide.
It is, yes, and I think I've just been given a 3-minute warning. So to wrap up, I hope that you found a lot of what the panellists were saying interesting. I hope that you found it pragmatic and also forward-looking as well. And as Simon quite rightly said, it's not that far off. So I think maybe, given it's near the end of the year, could we wrap up with each of you quickly a prediction for 2019? Who wants to go first?
So I think the major institutional volume for anything involving DLT will come from Europe or the US, not Australia. And I think it will happen either in private equity or real estate or one of the alternative asset classes, probably not in the traditional asset classes.
Interesting. Chris?
I think you'll have some commercially live products on the post-trade side, which will be involving a material portion of the market. We're not talking hundreds of participants, but some of the larger players will be conducting some of their business, leveraging blockchain in a post-trade. And on the immobilization side, I think you're just going to see an increased amount of DLT-fueled investor solutions. Mm-hmm. And I'm not saying cryptocurrency, I think beyond that.
Yep.
Yeah, I think we're going to see some real deliveries that will make people on the buy side feel that this is theirs rather than just something the sell side's going to do to them. I think the ideas that we've been talking about today are going to get greater currency and they're going to become more standardized and embedded. So the patterns for implementing immobilized and tokenized assets and cash will become much more established and will become much more respectable. And at that point, the existing market infrastructure is going to get very scared.
Okay, great. Thank you very much. Thanks to you all for coming and hope you enjoy the rest of the day.
Thank you, everyone.
Thank you.